We have taken some phone calls of, hey, should I be making changes before the election? Historically, Larry, that's a bad idea. I think we wait and see what plays out before we make any major changes.
Well, every Saturday morning we do a program called Retirement Matters. Dale Smothers, he's a local gentleman right here. He's the owner and operator of R.D. Smothers Wealth Management right here, pretty much across the street from the Big Dog radio station. And good morning to Dale.
Good morning, Larry. How are you, sir?
Always good to hear from you and doing well today.
Likewise.
Well, let's talk money.
Yeah, let's
interest
do it.
rate cuts, stock market, things like that. I know we had some interest rate cuts that have prompted the stock market. Folks with 401ks have got to be enjoying what's going on with Wall Street. And it's a good time to be invested with a 401k.
Right. And this 401k that you've seen likely increase over the last couple of days is almost a direct result of the interest rate cut that we saw, 50 basis point cut. Now, what that means for the common everyday U.S. citizen that's out there maybe borrowing money is that you can borrow that money a little bit cheaper to buy things that you need, such as a house. So we could see things like mortgage rates start to come down, which they already have. They had priced in around a 25 basis point cut, which is 0.25%.
And auto loans, the interest rates on auto loans are dropping.
Correct, yes. And so we've seen the mortgage industry kind of price in this 25 basis point, but now we're seeing it absorb the 50 basis point, which is why we've seen specifically mortgage rates come down just a little bit in the last couple of days, even weeks. Auto loans, direct result of that. Anywhere that you're borrowing money, you should be able to borrow it a little bit cheaper than you could just 2 or 3 weeks ago because of this Fed cut. This Fed cut has been a reversal of sorts for the Fed because for the last 2 to 3 years, we've been seeing them raise interest rates. And now for the first time in nearly 4 years, we've seen a rate cut, which is a sign that they have now switched to their dual mandate. Larry, let's talk about that for just a second. The Federal Reserve's number one job in their day-to-day life is to make sure that this U.S. economy has a flat type of trajectory, right? That it's steadily going up. We don't see a lot of ups and downs, a lot of wild swings in two main areas. One is unemployment and one is inflation. This is what we call the dual mandate of the Federal Reserve. Make sure unemployment doesn't get out of control. Make sure inflation doesn't get out of control. And they have been attacking inflation now for the last 2 to 3 years pretty aggressively, which is what we've seen since 2022, where interest rates have started to climb. They did that to try to pull money out of the system, get fewer dollars chasing the fewer goods, ultimately killing inflation. They've gotten inflation to an acceptable rate in their eyes, 3%. They were targeting 2, it's now 3%. 3% year-over-year growth in inflation. They are cooling their attack against inflation and now focused on the labor markets. They are concerned with a potential labor crisis, and this is why we are starting to see rate cuts. Oddly enough, labor rates or labor numbers right now look okay. The reports that we're reading are showing a strong labor market. So they've got to be seeing something in the tea leaves, perhaps that we're not seeing. This could cause inflation to reignite if we're not careful. They talk about this soft landing, trying to just land it softly. This is what I think it means for an investor. It means a little bit of turbulence comes over the next 6 to 12 months. We're entering into October. So what we just talked about with the 401k going up, be okay. Don't be surprised if in October we see it start to come down again. Typically, October is the time where sellers are more prevalent than buyers.
Unless the Feds lower the interest rate again.
That is true.
Because they're anticipating possibly 2 more adjustments
rate cuts.
Rate decreases, right, between now and the end of the year.
And this could be an anomaly that happens. If it happens in October, we could see this stabilization of prices in the stock market. But historically speaking, October's not a good place to be in a 401k. It's not a good time or in the market in general. So don't be perplexed if you start to see that come down. Just weather the storm. Don't jump off of the airplane. We talked about this a few weeks ago. I'll tell you this, once the election is behind us, no matter who it is, with that uncertainty behind us, I think it will lend itself favorably in the markets. The markets should do fairly well after the election is behind us because it's not about politics out there that we're hearing. You know, we're hearing one extreme and the other, two totally different ends of the spectrum in some cases. What we have to worry about is policy. And as long as the House is divided, we don't probably see many of the politics that we're hearing right now that are being spewed out on the campaign trails really coming to fruition. That's good for the market. Here's the point. If you are looking at your investments over the next 6 to 12 months and you see volatility, be okay. Don't be concerned. If you're over the age of 59 and a half, you have the opportunity in that 401k to perhaps move it to things like IRAs, even while you're working. This is what we call about an in-service rollover. That is a possibility.
Talking about that Saturday.
We talk about that often because it gives you a lot of control over your money. And from there, we can buy things that are a little more stable than perhaps what's inside of your 401k.
And that's for people who are looking to retire within the next 5 years.
That's exactly right. Yeah, so the 59 and a half is kind of that point at which you need to maybe start considering this option. And if you're going to work till 70, maybe you leave it in the 401k because you're still in a strong growth mode. I'll tell you a couple things that I see right now in the market that you might want to even pay attention to if you're looking out there right now for a good place to put some money. There's a couple of stocks specifically that we may even discuss here. They're ETFs, and so it's an exchange traded fund, like a basket of stocks. Instead of buying one particular stock, maybe you look at a stock like JEPI. This is a JP Morgan income fund that is geared towards trading options against really good companies. What that means is you get the dividend of that company, plus you get options premium, a higher yield. Right now we're yielding about a 7% dividend from this particular ETF. It's a pretty powerful place for income play. Another one is coming out in October is POCT. Now this is a pretty unique position in the market. It gives you 15% protection for 1 year period of time. If the S&P 500 is down 20%, you're only down 5%. If the S&P is up, you still get a healthy dose of the upside. This type of stability can be built inside of an IRA. It's difficult to do that in a 401k. So over the age of 59
that's
and a half,
just telling me there's some good psychological confidence going on as well.
For sure.
In the market.
So the market's strong. I don't see anything that's, an emergency for us to react to right now. We have taken some phone calls of, hey, should I be making changes before the election? Historically, Larry, that's a bad idea. I think we wait and see what plays out before we make any major changes.
I think we take a breath because I'm seeing something that's given me a real indication that inflation is cooling.
Sure.
We're seeing $5 value meals back at the restaurants.
This is true.
That's a good sign because if restaurants are now doing value meals, $5, $6 meals, things like that,
Sure.
and that's at all the major restaurants now.
That's going to help.
So that's going to help.
That's going to help.
And people are still spending money like it's going out of style. What's up with that?
The retail numbers came out very strong, and so it shows us that people still want to shop. For good or bad, people still want to shop.
Still buying cars.
And this is not a bad thing, except if we're thinking through it with inflation. If money gets cheaper and people still want to shop, we could see inflation reignited. So we have to be careful. And again, in a retirement plan, if you're less than 5 years from retirement, you need to be prepared for this type of volatility that could result in the market. We talk about it all the time. In retirement, you've got to pull away the success of your retirement. You've got to detach that from the success of the stock market. And if you do it properly, it can be done.
You got about a minute. So if you'd like to have someone to come and talk to them, maybe a little bit more about the stock market, about the investing money and things like that.
Absolutely.
Hey, give us the who, what, when, where.
Absolutely. So at RDS Wealth, we build holistic retirement plans. Investments are a piece of what we do. It's a big piece of what we do to make your money work for you to generate the income you need with as stable returns as possible in the market, risking as little of it as possible to be able to accomplish your objectives. We also talk about Social Security, Medicare, long-term care. All of these things go inside of that holistic plan. And if we can help you in any way, of course, you can always tune into the show on Saturday mornings right here on the Big Dog. But if you would be interested in talking to someone on the team, 270-600-PLAN. That's 270-600-7526. Get in touch with us. We'd be happy to sit down with you and discuss things.
There he is, folks. Dale Smothers with RD Smothers Wealth Management. He does his program Retirement Matters every Saturday morning after the 9 o'clock news right here on 99.9 The Big Dog. Dale, thank you. Have a great rest of the week.
Larry, you do the same.